Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today, we're looking at Wendy's.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So we're looking at a situation today that it really perfectly illustrates that massive tension between a struggling legacy brand and like a really profound market opportunity.
Yeah, it's a fascinating setup.
It really is. I mean, think about a stock that has just been absolutely battered. We are talking about a steady, painful 40% drop over the last 12 months alone.
Which is brutal to look at.
Exactly. For most investors, a chart bleeding out that consistently, it just looks like a glaring warning sign to stay far, far away. But then we hit May 12th.
Right, the big shift.
Out of nowhere, the stock experiences this violent 14 to 16% intraday upside explosion. Suddenly, the entire narrative just flips on its head.
It completely changed the conversation overnight.
So today, our mission is really to unpack this. We're looking at their first quarter 2026 earnings beat, a fundamental picture that is, frankly, looking a lot better than the market feared. And of course, the immense M&A speculation surrounding a potential take-private bid.
Yeah, the billionaire interest is the real wild card here.
Right. We have a burger chain intentionally cutting store hours, yet billionaires are circling the property. It's a puzzle we need to solve for anyone trying to figure out if this explosive chart move actually changes the landscape for long-term investors.
Absolutely. There are a lot of moving parts to sort through.
All right, let's move into the wealth-building context.
Sounds good.
When you sit down to build long-term wealth, you generally prioritize, stability, compounding growth, minimal downside, average stuff.
Exactly, the usual pillars.
But if you zoom out on this particular quick service restaurant chain, the stock has declined 75% over the past 5 years.
Yeah, that's a tough pill to swallow for early holders.
Right. So as someone who always looks at risk first, I just have to ask, how does a stock with that kind of historical wealth destruction even fit into a long-term portfolio? I mean, if you're looking at your screen right now, this looks suspiciously like a falling knife.
Yeah, I totally get that. That is a very fair initial read if you are solely focused on the 5-year chart. However, wealth building isn't exclusively about just buying passive index funds, right?
Sure.
It also requires identifying asymmetric turnaround plays. And like an asymmetric play is basically a setup where your potential upside significantly outweighs your downside risk.
Okay, I'm tracking.
What we are seeing here is really a classic value unlocking scenario. It fundamentally changes the risk-to-reward ratio for anyone looking at the stock today.
Break down what value unlocking actually means in this scenario, though, because to the average observer, a fast food chain struggling with domestic sales doesn't exactly scream hidden treasure.
No, I mean, on the surface it doesn't, but it boils down to activist involvement. Specifically, Nelson Peltz and his firm, Tryon Fund Management.
Okay.
When an activist investor of that caliber steps in, declares the stock undervalued, and begins exploring a buyout, they create what the market calls a valuation floor.
The structural safety net, essentially.
Exactly. Think of it just like that. Even if the day-to-day operations take several quarters to fix, there is a literal billionaire with a powerful financial incentive to ensure the stock price doesn't plummet further.
Wow. So they actively force the market to recognize the underlying assets.
Right. And that really limits the downside risk for the everyday investor riding their coattails.
Now let's look at the fundamentals.
Let's do it.
Because all the billionaire activists in the world, they cannot sustain a business that doesn't actually generate capital.
Very true. The numbers have to make some sense.
Unpacking the first quarter of 2026 numbers reveals this fascinating split reality. Overall revenue actually beat expectations, coming in at $540.6 million.
Which is up 3.3% year over year. Not bad at all.
Right. And adjusted earnings per share hit 12 cents, beating the 10-cent estimate. But that is still down from 20 cents the prior year, primarily because inflation has just been eating into their margins.
Yeah, inflation is hurting everyone in the sector right now.
Definitely. But the deeper story, though, is the stark divide between their domestic and international operations. U.S. same-store sales dropped a painful 7.8%.
It's a big hit.
It is. Management is attributing this to severe weather, but also to intentional hour cuts from an initiative they call Project Fresh.
So the psychology and economics behind Project Fresh are actually quite brilliant, even if the headline number looks terrible.
Wait, really? Because deliberately cutting hours sounds like a terrible idea for a restaurant.
I know it sounds counterintuitive, but they are deliberately reducing operating hours during low traffic periods. Like, if a late-night shift costs you $200 in labor and utilities, but you only sell $150 worth of food...
You're just losing money staying open.
Exactly. Staying open is actively destroying capital. By cutting those unprofitable hours, the top-line sales number shrinks, which is what causes the 7.8% drop you mentioned.
Oh, I see.
But the overall profit margin of the business actually becomes healthier because they aren't bleeding cash at 2 in the morning. And while the U.S. optimized its footprint, the international segment really carried the weight.
Because international system-wide sales grew 6%, right?
Yep. Driven heavily by rapid expansion in places like the Philippines and Mexico.
Which highlights that the core brand still translates globally.
Oh.
But what really stands out to me in these fundamentals is their digital moat.
Oh, the digital growth is huge.
Yeah, U.S. digital sales grew 8.4%. Digital orders now make up nearly 23% of their entire sales mix. And they're integrating a new AI recommendation engine directly into their app.
That is such a big deal for them.
Right. That isn't just a gimmick to sell more fries. I mean, they are building a predictive, tech-enabled sales funnel.
And that AI integration is a phenomenal margin driver. Think about it. When almost a quarter of your customer base interacts with an algorithm that tracks their ordering habits, the app can execute completely frictionless upselling.
Like suggesting items based on past behavior.
Exactly. If the AI knows you order a spicy item every single Friday, it automatically prompts a side of ghost pepper ranch. It increases the average ticket size without requiring a single extra second of human labor at the drive-through window.
That's incredibly efficient.
But the ultimate fundamental bedrock of this business, like the real reason activists want it, is the franchise model. They operate over 7,200 asset-light global locations.
Wow, 7,200.
Yeah. To put that scale into perspective, a highly hyped competitor like Shake Shack only has around 555 units. Furthermore, they just secured a massive new 1,000-unit franchise agreement in China.
We should probably clarify how that asset-light model functions, though, because it's kind of similar to a software company licensing its code.
That's a great way to put it.
The corporation doesn't have to spend millions pouring concrete, buying real estate, and building out 1,000 physical restaurants in China. They simply provide the brand, the supply chain guidelines, and the recipes.
Right, they just hand over the playbook.
And then they just collect high-margin royalties right off the top.
Precisely. The heavy capital expenditure is offloaded entirely to the franchisee, leaving the parent company with this highly efficient recurring revenue stream.
That sounds incredibly resilient on paper. But keeping my risk-aware hat on here, their balance sheet gives me serious pause.
Yeah, the balance sheet isn't pretty.
It is heavily leveraged. Long-term debt is sitting over $4 billion. Their debt-to-equity ratio is over 35, and their net leverage is 4.9 times adjusted EBITDA.
Which is high, no doubt about it.
Yeah, and for anyone unfamiliar, adjusted EBITDA is essentially the raw cash the business generates from its core operations, before the accountants, the tax man, and the lenders take their slice.
The pure operating cash.
Exactly. So operating at 4.9 times that number places them at the absolute ceiling of management's own leverage targets.
Yeah.
I mean, in a high-interest rate environment, carrying that much debt while U.S. sales are dropping, it just feels incredibly precarious.
Look, the debt load is substantial. There is no ignoring that reality. However, companies service debt with cash flow, not just top-line sales.
Okay, that's a fair distinction.
Despite the U.S. sales dip, the franchise royalty model we just discussed generates incredibly robust free cash flow. In the first quarter alone, free cash flow hit $47.5 million.
That's pretty solid for a single quarter.
It is. And their full year 2026 guidance remains totally intact, projecting between $190 million and $205 million. Crucially, management made the strategic decision to pause all share repurchases to focus entirely on debt reduction.
Oh, interesting. So they're halting buybacks.
Yes, pausing buybacks to pay down debt is a highly mature, disciplined capital allocation move. They are prioritizing the long-term health of the balance sheet over any kind of short-term stock manipulation.
That brings us to the catalyst timeline.
There are a lot of dates to watch here.
What are the actual events expected over the next 3 to 6 months that could drastically re-rate this stock's price? We really have to start with the true elephant in the room, right?
Nelson Peltz.
Exactly. Nelson Peltz and his Tryon Fund Management. Tryon holds a controlling stake somewhere between 16 and 40%, depending on the specific share class, and they are aggressively exploring a take-private bid.
Yeah, they want to buy the whole thing.
And the current reporting suggests they are in talks with Middle Eastern sovereign wealth funds to actually finance the deal.
Which changes the game completely. Sovereign wealth funds operate on an entirely different plane than traditional public markets. They possess virtually unlimited patient capital.
So they aren't sweating the day-to-day stock price.
Not at all. They aren't worried about hitting a quarterly earnings target. They want decades of steady cash flow, which a 7,200-unit franchise empire provides.
Makes sense.
If Tryon forms a consortium and submits a formal tender offer, historical precedent dictates it would come at a significant premium to that recent $7 to $8 trading range.
Yeah, they'd have to pay up to take it private.
But beyond the boardroom maneuvers, the company is actively deploying operational catalysts, too. Like, they are rolling out a completely revamped spicy chicken sandwich featuring a new panko breading.
Nice.
Alongside the relaunch of the pretzel bacon pub burger and an aggressive push on their Biggie value platform to drive foot traffic.
I sort of look at the activist buyout rumor like holding a specialized insurance policy on a fixer-upper house.
Oh, I like that analogy.
Yeah, you buy this house, the stock, knowing the foundation is heavily leveraged and the domestic traffic needs serious renovation. You hope the kitchen remodel, which in this case is the new panko-breaded spicy chicken sandwich and the Biggie value menu, actually brings in fresh buyers.
Right. You want the remodel to pay off.
But even if the kitchen remodel goes poorly and the neighborhood loses interest, you have a billionaire holding an insurance policy, actively searching for a wealthy buyer to take the entire property private. It significantly limits the downside risk while you wait to see if the renovations work.
I definitely see the logic in that comparison. But the real power of this setup is that you aren't just relying on the renovations or the billionaire.
What else is there?
You also have macroeconomic tailwinds aligning in their favor. We are forecasting a sharp easing of double-digit beef inflation in the second half of 2026.
Oh, dropping down to low single digits, right?
Exactly. When the primary cost of goods sold drops that dramatically, it creates a massive margin tailwind. Even if the new chicken sandwich fails to drive a single new customer and top-line sales remain perfectly flat.
The profits still go up.
Yes. The company's profitability will surge simply because the raw ingredients cost significantly less.
Now let's pivot to the chart.
This is where things get really wild.
For funds, the price action was excruciating for shareholders. I mean, the stock was just trapped in a multi-month base, violently whipping around the $6.50 to $7.20 zone without any real direction.
It was dead money for a while.
Yeah, it really was. But the May 12th news broke that stagnation. We saw a violent gap up on heavy trading volume, pushing the stock firmly into the $7.80 to $8.30 range.
It is an explosive move.
So let's unpack the specific market mechanics driving that violent upside explosion.
Yeah, what you witnessed on May 12th was the anatomy of a textbook short squeeze.
A squeeze, okay.
Prior to the earnings release, bearish sentiment was at an absolute extreme. Short sellers, who basically borrow shares and sell them hoping to buy them back later at a lower price, they were betting heavily that the 5-year slide would continue.
Right, they thought the stock was going to zero.
Exactly. But when you have elevated short interest colliding with an explosive fundamental catalyst like a better-than-feared earnings report and renewed M&A chatter, those short sellers become trapped.
Because the price is going up, not down.
Yes. As the price spikes, their brokers demand more collateral. To close their losing bets, they are forced to buy the stock at the current market price.
Wow, so they become buyers themselves.
Exactly. This forced buying loop acts as rocket fuel, driving the price up even faster. Interestingly, if you look closely at the data, the stock had quietly returned 6% over the previous 30 days before the news even hit the tape.
Which indicates that institutional accumulation was happening just under the surface. I mean, the smart money was quietly building positions in that $6 range, absorbing the available supply right before the breakout occurred.
They definitely knew something was brewing.
So what does market sentiment look like?
It's extremely divided right now.
Currently, The landscape is defined by this fierce tug of war between skeptical traditional analysts and opportunistic quantitative models, with the activists caught in the middle. On the institutional flow side, the narrative is totally dominated by Peltz declaring the stock severely undervalued.
Right. The analyst community, however, is deeply fractured. Quantitative models, which base their valuations purely on mathematical projections of future cash flows, see tremendous upside.
Like simply Wall Street.
Exactly. Simply, Wall Street places the fair value anywhere between $7.98 and $14.22.
That's a huge range, but plenty of upside.
And the TIKR model sets an $11.34 target, which would imply a 55% total return from recent levels. Traditional banks are slightly more cautious, but starting to pivot, like Citi just raised its target to $7.75.
But the bearish holdouts remain vocal. TD Cowen maintains a strict hold rating with a stubborn $6 price target.
Yeah, they are not buying the turnaround story yet.
They are zeroing in on the ongoing skepticism regarding the actual operational turnaround. They just aren't buying the activist hype until they see actual physical cars in the drive-thru.
Which is fair. They want proof.
Now let's talk about the risks.
Because there are definitely real risks here.
If that activist buyout fails to materialize and the sovereign wealth funds just, walk away, the operational dangers are very real. The brand faces fierce value competition from absolute juggernauts like McDonald's and Burger King.
The burger wars are no joke.
Furthermore, company-operated restaurant margins compressed heavily by 340 basis points, dropping down to 11.4%.
That is a tough squeeze on the corporate side.
And just to translate that, a basis point is 1/100%. A 340 basis point drop means that for every single dollar they bring in, they are keeping 3.4 cents less than they used to, just on the operational level.
That margin compression is a stark reality check. If inflation remains sticky and wages stay high, operating those corporate-owned stores becomes increasingly difficult.
Right, and add to that the U.S. traffic collapse. If these new menu items, like the panko breaded chicken, if they fail to reverse the negative domestic sales trend, management might be forced to cut their second-half guidance.
That would be a disaster for the stock price.
And remember that 4.9 times leverage ratio we discussed. Failing to stabilize their EBITDA could threaten their debt covenants.
Yeah, we have to talk about the covenant.
A debt covenant is essentially a legal tripwire set by the banks. If the company's earnings drop below a certain threshold, the bank can demand immediate repayment or enforce severe penalties.
Nobody wants to trip a covenant.
Exactly. To avoid tripping those wires, management might be forced to cut the dividend. If the dividend gets cut, the institutional dividend growth funds will automatically dump the stock, and that valuation floor we talked about could entirely cave in.
Those structural risks are absolutely present, but you have to view those risks through the lens of current market pricing.
Okay, what do you mean by that?
Well, the market is a forward-looking discounting mechanism. A profound amount of this operational pessimism is already baked right into the stock's current price.
So the bad news is already priced in.
Largely, yes.
What?
You are looking at an 8.6 times forward price-to-earnings multiple. Forward PE simply asks, if you bought the whole company, how many years of its projected earnings would it take to pay you back?
Under 9 years in this case.
Exactly. Historically, high-quality franchise models trade much closer to 15 or 20 times earnings. At 8.6 times, the market is already pricing in a complete disaster.
I'll see.
You aren't paying a premium for perfection. You are buying at a deep discount where even mediocre performance, or just a slight return to the historical baseline, generates substantial upside.
So with everything on the table, what's the final verdict?
Based on the structural setup, I am giving this a WEN bullish score of 7 out of 10. We can define this as a deeply asymmetric 6 to 12-month event-driven turnaround play trading at a massive discount.
A 7 out of 10, okay.
Taking the long-term view, the risk-to-reward ratio is heavily skewed to the upside. You have the worst of the commodity headwinds lapping in the back half of 2026, an AI-driven digital platform expanding average ticket sizes, and a legendary activist holding the line.
So a lot of safety nets.
Right. You don't need operations to be perfect to win here. You have multiple paths to profitability.
Yep.
Margins expand as beef prices drop. Digital sales compound, or the company simply gets taken private at a premium.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
As you review your portfolio this week, consider this. The future of the restaurant industry might rely a lot less on the secret recipe of a chicken sandwich and a lot more on the financial engineering and AI algorithms quietly running the drive-thru. Something to think about.